So I think a good place to start would be just getting clear for everyone on what the contribution and deduction limits actually mean. Because first thing people tell us is, I make too much money to use a Roth IRA. And that's only partly true.
Indeed. Indeed. So, Jordan, if you can cut to my screen here, we're just going to walk you through a little bit of the income limits of IRAs and Roth IRAs and why people get tripped up thinking that they can't do it. So to start off with, we just have a regular traditional IRA. This is an IRA you set up in your name. It's the IRA that's existed for decades. And you have no income limits. You can make as much money as you want and put money into an IRA. Mm-hmm. The income limits are based upon two things. One is, do you have a 401k? Because the income limits are not about contribution in an IRA. That's a big misnomer. It's about the deduction of the contributions to an IRA. So that traditional IRA is non-deductible if either spouse has an employer-sponsored retirement plan and the household makes over $74,000 if you're single or $123,000 if you're married. Now, Corey, will you just talk about the phase-outs for a second?
I mean, so starting at $103,000 for a married couple, you can't deduct all of your contributions to the IRA, but you can deduct some. And then by the time you hit that 123, you can't deduct any of it. Now, I get it. I know why, because the person, if it was just 123 and the person who made, 124 was cranky because like, $1,000 and I could have deducted, now I can't. So they set up this phase out range, but it's, it's only 20,000 and it's a deduction on a $6,000 contribution. So like the total net impact one way or the other, it's not like it's the hugest thing in the world. It creates all this needless complexity of, I got to keep track of this phase out range. I think it's one of the reasons why, the IRS is, considered a little bit inefficient. Like we have all this cost of administering the tax code and why people push for simplification. This is one of those things.
Exactly. And the one big thing to remember is that there is this phase out that occurs if neither spouse has a 401k. If one spouse has a 401k, you're subject to these phase outs on your deductibility of the IRA. Now,
the other side of it is that if neither of the spouse has a retirement plan at work, then you don't need to worry about the income levels for the purposes of deduction.
Exactly right.
Yeah.
That employer-sponsored retirement plan is key, not just 401k. There's several types of employer-sponsored retirement plans. All of them, if either spouse has one, will knock you out of the deductibility at any income. And you'll be subject to these phase-outs. That is traditional IRA. Now, if you are subject to the phase-outs, let's say you make $300,000 a year, have a 401k, something we see a lot, for some reason, it tends to be around people who work in technology and highly analytical spaces. I would contest that it's because they understand the power of the math of compounding without taxation each year. So we notice a bunch of people will make after-tax IRA contributions when they make over a certain amount of income. And how that works is you have a basis, that's the amount you don't have to pay taxes on again. You make your contribution every single year, and then when you take your distributions, you pay your tax on the growth. Pretty simple. Here's the trouble, and we're going to talk about this again in a few minutes. It's your responsibility as the taxpayer to track that basis. So if you make a $5,000 a year contribution, to make my math easy here, I'm doing this off the top of my head, for 20 years, you have made a $100,000 contribution. If it's worth $500,000, then you have $400,000 of gain and $100,000 of basis, so that when you take distributions, you don't have to pay tax on the $100,000. And there's something called a pro rata tax rule we'll talk about as we wrap up this episode. But here's the key. It's your responsibility as the taxpayer to track that basis. So if you're making contributions at age 45 and maybe you don't take your first IRA distribution until 70, you've had to keep those records for 25 plus years. I have a hard time keeping hold of a pair of running shoes for a year and a half. I don't think I'm going to be able to track tax records for 25 years with the level of efficacy I would want to take those contributions back out tax-free. So let's transition to Roth IRA. Roth IRA has a phase out similar to traditional IRAs in how it phases. except the limits are a little bit higher. But now, once you're over the
And
phase out,
why wouldn't they make them the same stinking numbers? Why?
They just need to make them higher because, feelings. I don't know why. So the Roth IRA phases out from 122 to 137 if you're single, and the phase out is 193 to 203 if you're married. Now, so for the most part, the clients that reach out to us and apply to become clients, we think most of our listeners just out of hand don't qualify to put money into a Roth IRA. And here's the trouble. Even if you're close, one of the problems that can happen is you make your Roth IRA contribution earlier in the year, and then your business is unexpectedly more profitable. You're having a breakout year. Or if you're an employee and you get a bonus. Uh-oh. Because it's all sources of income, your regular wages plus your K-1 distributions from your business. But here is the part that gets fun, which is the ability to convert Roth IRA to Roth from taxable to non-taxable. We just have to pay the taxes one time. Now, you could do this all or in part. You could say, I have $100,000 in IRA. I'm going to convert it all this year. Corey, what happens to them tax-wise if they just convert all of an IRA to Roth in a single year?
That $100,000 in your IRA filters right into the tax bracket that your last dollar that you earned in your paycheck went, and potentially bubbles over into the next one. So you do have to be careful and be aware of where you are on those tax bracket levels. And no, it's not the end of the world if you bubbled over to the next one, but you do want to do the math to make sure that it's still a valuable transaction for you by paying the extra tax at that higher level.
Exactly right. That is key in the realization in the difference between your marginal tax rate and your effective. You might get your tax returns back from your CPA and it says that you paid on average 23%, but that includes your lowest brackets averaged with your highest brackets.
Right.
When you do an IRA to Roth conversion, it's going to be at that last highest bracket, which might be 30-some% for you, including if you're in like California, New York, New Jersey, or many, many other states with a regular state income tax also, you're going to have that taxed as well on the conversion. We don't get to escape it unless you move out of the state. So
now, Paul, can I just I'm the ranty one today. If folks are a little confused, this is where the confusion comes from, because they say, "Oh, I knew that there was this income limit for me putting money into a Roth, but I can just change any of my money into Roth at any time still?" Wait, I thought, yes, it's a situation that I think only politicians could create that is a little wackadoo.
I hope you enjoyed today's video. Thanks for watching. Be sure to subscribe to our channel, ring that bell, and by the way, make sure to share this video. I don't know if you know this, but my cyborg body runs 100% on YouTube views and likes. Please don't let my batteries die.